Welcome to Nonsense Season 3, Episode 57, our big story and our second show of the week. I'm Jeff Parker.
I'm Stu Little.
This time we're looking at Code Red. Is the AI gold rush heading for a crash? Up next.
.com bubble, an AI bubble. Why can't we just have a brisket bubble? All I want.
Sure, why not?
Just briskets for everybody. I want to be paying for things in brisket.
Overinvestment in brisket, where you're getting brisket for much less than its cost to make it.
Well, okay, let's not think about the cows. I want to be checking like a meat index every day.
On your Bloomberg terminal?
Yeah, of course. The Bloomberg code would be meat. And then I just want to be the Franklin Goldwyn index is really off the charts today.
Franklin Goldwyn index?
Yeah. Aaron Franklin and Meathead Goldwyn. You know, I would be a happier person.
Oh, that's delightful.
Right?
Back to AI bubbles.
Fine.
Whether it's a bubble or not, the infusion of cash has pushed AI forward way faster than it would have otherwise gone.
I think it also made my power cost go up.
Oh, man. Yeah, absolutely. Your electrical costs are much higher.
Every time I turn on like a light, I just feel like there's a part of ChatGPT that groans because it no longer has all the power it needs.
You turn on a light and your bank just gets a little smaller.
I'm not looking forward to the day when OpenAI integrates clipping. It's like, ding, ding, ding. Do you really want to use that hairdryer? Because then I can't make videos of Will Smith eating pasta.
Dave, put down the hairdryer.
I kind of look forward to that day.
Okay, the AI illusion separating hype from hard revenue. Let's go.
This is going to be fun.
The race is on and the stakes couldn't be higher. Generative AI is not just the hottest commodity in Silicon Valley, it's the new digital gold, driving company valuations into the stratosphere and forging a new dynasty of instant billionaires. Yet behind the triumphant headlines and the champagne toasts, an unsettling shadow looms. Is this a bubble? This frenetic, almost manic pace feels terrifyingly familiar. Companies with thin revenue streams and no clear route to actual profit are somehow commanding billion-dollar valuations. A torrent of often borrowed capital is flooding into competing models, speculative real estate, and massive power infrastructure, a colossal bet on an unproven future. This is not a scarcity of technology, it's a profound scarcity of proven business models. While the underlying technology is indeed revolutionary, the necessary immediate market adoption and revenue growth to justify these astronomical prices are simply not materializing fast enough. When the initial blinding euphoria invariably fades and the market cools off, when investors no longer accept potential but demand concrete results, will these trillion-dollar expectations hold steady? The financial history books are clear. The end of a mania is never a gentle landing.
Well, you don't sound very optimistic about this whole AI thing.
I'm Jeffy Sunshine.
I feel a little bit of pessimism coming out of your business model. Who needs a business model? Come on.
Let me break this conversation before we start into just 4 quick little sections so we have some idea of where we're going.
The part where I'm wrong, that's the first section.
I was thinking the first part we're going to discuss, what's a bubble and why might this be a bubble?
Okay.
Part 2, how much money are we talking about here? The debt, the revenue, all that kind of stuff. Just the actual business stuff. And segment 3, aren't there a bunch of circular investments happening here? We need to discuss what those are, what round tripping is.
It sounds dirty when you say it that way.
It might be a little bit. And 4, the last section, how might this end?
Poorly. Well, that was a quick show. Thanks for coming, everybody.
The tech is real, but are the valuations a silicon mirage?
Oh, I see what you did there. I mean, isn't that like the $1 million question? Isn't that how we end up here?
It's
the $1 trillion question?
Yeah, sorry. $1 trillion question.
I'm stuck in 1970s dollars.
That was a little bit Austin Powers of you.
Totally. It is kind of crazy that these are real numbers that people are dealing with, right? You've got like private valuations of $500 billion. And you're like, wait, is that right? Did I miss a comma and 3 zeros? Like, what? Are we sure?
OpenAI valued currently at $500 billion.
$500 billion in the secondary market. Just to provide some amount of liquidity to their employees, really. I think that's mainly why that was done. My thing is, though, doing a little bit of searching around on this. I was trying to find, like, what is a concrete definition of a bubble? Mm-hmm. And it seems like it might be somewhat impossible because of a couple of reasons. One, nobody really agrees on what a bubble is.
Okay.
And it's not something that you can really see when you're inside of it. It seems like it's more clear afterwards. You can look back and go, well, that was a bubble and here's why.
When it pops, we have 20/20 hindsight. Running into it, most of the world doesn't see it, which is how it inflates, because if you saw it, it wouldn't inflate.
It seems like, I mean, at least my small dinosaur-sized brain tells me that it would be like when the price of an asset has risen significantly above its intrinsic value.
Yeah, that's about right.
However, what's the intrinsic value of these things now? Like, even if after the thing pops, what is the intrinsic value of OpenAI? Nobody knows. How would you value it, right? Based on its revenue at that moment for the product's not complete. But then if you listen to Sam, it's like, well, it's going to take us 10 years to get the profitability.
Yeah.
And I'm like, he didn't even smirk when he said that.
Yeah.
He said that with a straight face, which is amazing and probably true.
Can I tell you something?
Yeah.
Happy birthday to OpenAI. They are approaching this December their 10th birthday.
Oh, sure. Yeah. Isn't that crazy?
This is not a brand new company.
No.
This company has been around for, in December, 10 years.
Wow, that's crazy.
And they are nowhere close to being profitable.
No.
Like not anywhere even in the vicinity. $13 billion in revenue. That's what they made. $13 billion in revenue over the trailing 12 months.
What a clear analogy you just provided. They're not even, they're on a different planet, if you will. Yeah. So I do what I do because I'm a dinosaur, and I go to Wikipedia, which I'm sure ChatGPT will be replacing soon.
Yes.
They describe, or I should say behavioral finance on Wikipedia. Behavioral finance theory attributes stock market bubbles to cognitive biases that lead to groupthink and herd behavior.
Herd mentality. Flood in. Let's all go. We all have to have AI.
I'm like, yeah, that sounds pretty good.
Herd mentality is really useful. Herd mentality has kept humans and other creatures alive for most of their evolution.
Yeah.
Just because someone yells, hey, look, a tiger, and the rest of us all run away so we don't get eaten, we survive. But if we all wait until we see the tiger, it could be too late.
Yeah. No. What's a bubble?
What's a bubble? A bubble is when you have $500 billion valuations for single companies in a market where the entire revenue of the market totals about $70 billion.
Sure. But
that's the entire revenue of the market
So
this
you're
year.
Already convinced that that's a bubble. That defines the bubble.
Well, here's the thing. Yes and no. Let me just explain. There are types of bubbles where things completely even go away. I mean, you look at the .com bubble, massive overvaluation of everybody going into the business, pets.com and a million of other companies that had no revenue to speak of, put tons and tons of investment dollars out there and advertising out there. And when the bubble burst, e-commerce didn't go away.
Yeah.
E-commerce is still a thing. We still buy and sell things off the internet.
Yeah.
It advanced us. You saw lots of competition and lots of advancement, innovation in the area, but we still have e-commerce. So the AI bubble probably will pop at some point, and we'll still have AI, and we'll still use AI, and it will still be useful.
This is interesting because I think we can certainly agree. I think most people would agree that the .com bubble definitely popped. It was not an easing.
Yeah.
It was not a deflation. It was definitely a pop, right? You had a pretty sharp edge on that. And I certainly agree with your points there about how it was kind of like early, right? Maybe a little too big, too fast. Take our favorite punching bag, pets.com.
Yeah.
Those guys raised almost $100 million. Right? I think they raised $80+ million. They had Super Bowl ads. I mean, they were everywhere. Of course, long gone. But today you have Chewy, which doesn't own that market, right? They own a part of that market, but you still have Amazon selling pet food and pet supplies. But Chewy's like a $14 billion company.
If you've ever used Chewy, you fall in love with Chewy.
Yeah.
Those people are so good at what they do, and they're so good.
Yeah.
They know your pet's name.
Sure.
They send you a pet birthday card. They're a wonderful, wonderful, and it's all about service.
And that's a $14+ billion business.
I know. The valuation makes no sense. I can't tell you why that valuation makes any sense. Why would anyone pay that much for that business? What the multiple on that is 100x, the price to earnings ratio, meaning the price it costs to buy a share that returns you a single dollar of earnings is $100.
Yeah, that's a lot.
That's crazy. By contrast, what we call the risk-free rate, which is the 10-year treasury bill, will return for you for $25 investment, you'll get $1 back. And that's risk-free.
Yeah.
So why would you ever, when you can get $1 back at the risk-free rate for $25, why would you ever invest $100? You have to believe there's a ton of growth coming in their future. I think Chewy's been around for a while. I think we're good. This is kind of what it's going to be.
I think it's cute that you still think of T-bills as risk-free. You must not have the news at your house.
Well, think about it this way. If T-bills have a problem making their interest payments, the dollar has no value.
Oh, you have bigger problems.
You have much bigger problems than
everything
T-bills.
Else that has USD anywhere in its financials has much bigger problems than the T-bills. Of course. Sure. No, of course. I understand.
By the way, that's a crazy multiple for a treasury bill.
Yeah.
You'd be insane to buy treasuries with a multiple of 25.
Yeah.
So that means the treasury is returning 4%. The 10-year treasury is returning 4%. That's a terrible return in a world of where you're getting inflation right now, we're getting inflation around 3%, 3.5%, something like that. So your net gain is just minuscule.
Yeah, but risk-free, relatively speaking.
But largely risk-free, yes.
Yeah. The point is, you had a pets.com that we love to beat up on. Meanwhile, it was a reasonable idea, just maybe executed at the wrong time, a little too early. Like we spent a lot. We laid a lot of fiber. We spent a lot of money interconnecting the world. We ended up using most of it. Just took us a while to get there.
Once it's there, you're not going to not use it.
Of course. So now we are in this world of like trying to map AI into that paradigm.
The only thing I'm equating with the dot-com bubble and AI is that, yes, it is likely a bubble. Yes, it will likely pop. But in the end, we're still going to use AI. That part's not going away.
Okay, so I agree with most of you. I would like to debate the word pop. I'm not convinced it's going to pop. It might actually deflate. It's hard for me to say that given these insane valuations. But you do have earnings that are chasing these.
Yes, but you have very small earnings and they aren't growing fast enough.
Well, it depends on the company, right? Look at Nvidia, right? Nvidia is a $2.5 trillion business and their earnings is chasing, I should say their price is chasing their earnings, but it's at least parity. Whereas if I compare that to who was the Nvidia of the dot-com bubble, I would say it was probably Cisco. And Cisco, they had a fork in the road where the price went bananas and their earnings didn't really go up by much.
Sure.
And then, of course, you had a collapse, right? And then some sort of return to normalcy. So I'm not convinced that it is as much of a runaway train as we saw previously. There are something like in the past 3 years, you now have folks spending over $20 billion on consumer products that didn't exist 3 years ago. Yeah. That's a whole market creation. Now, that money likely came from some other pockets somewhere else, almost certainly in tech. But you have a new product category by new companies, new AI companies, relatively new companies that didn't exist even just a couple of years ago. So that to me is encouraging that perhaps you're not going to see the same retraction, or at least at the same rate that you saw with the dot-com bubble 20 plus years ago.
We're going to talk about Nvidia's returns because some of that growth is a bit of a mirage.
Well, that's kind of your second point, right? I think your second point touches on that, which is thinking about this circular investing.
Let's come back to that. We're going to come back to round tripping in section 3.
Yeah. Okay. Sorry. So what's the scale of this, right? I think that's what you want to talk about next. Like how much money are we talking about here?
Yeah.
The numbers that I saw from JP Morgan was that you have something like $1.2 trillion of debt that is now tied to artificial intelligence. And it has made it the largest segment in investment grade debt, now more than banks, which kind of breaks my brain. That's 14% of the high grade market.
I don't know how they get that number because most of that debt is hidden. Unlike when all that money was borrowed from banks for houses and things like that, where it went through banks, we could at least to some degree keep track of how large that bubble had become, how much debt. The reason we're concerned about debt is always with bubbles, you typically have an enormous amount of debt spending that can't be sustained.
Well, I think in terms of finding it, the companies that are public, especially the big ones, you can't hide that. It's pretty easy to find.
But there's companies like OpenAI, which are, is the monster in the room.
Yeah.
And you can't know what kind of debt they have. You don't know precisely what their debt is.
I don't know. How much of that do they disclose? I don't know. I know they don't have any requirement to disclose it, but I don't know. It's got to be at least disclosed to future lenders. It will be very interesting story if they are doing some trickery, right?
I'm in no way accusing OpenAI of financial chicanery of that type.
If you're looking for a large investment, even in the hotness of the market now, my hunch is you're probably disclosing what other debt you have. So that information is out there in the ether. My hunch is we've got a pretty good guess.
I mean, there's an awful lot of debt here that you are not able to see.
Yeah. To be clear here, these aren't just like AI software companies. These are companies that are closely tied to the tech of AI, right? So they've included like Oracle, Apple, Duke Energy, right? These companies are closely tied to AI. So they're trying to I think, articulate how much debt is around this sector. So that if you see a collapse in this sector, you would assume a bunch of that debt would be at risk.
Companies like Google, companies like Oracle, they probably don't need debt to do their AI spending. They probably have the actual capital to lay out.
That was another point they made, that JP Morgan made in this analysis, was that most of these companies are very cash rich and have relatively low net debt.
It's the other ones that I'm concerned about. It's all the people who are putting up, power generation facilities and buying the real estate to do that. I think all that's being financed with debt.
That's a good question. I would assume that's probably accurate, like on spec, that they're going to want to come in and build a giant 10 gigawatt facility there or lease it from you or whatever the thing is that you're looking to do.
Sure.
That's a good question. I don't know. I mean, who's writing a check for that if you can't finance it yourself? I mean, I know Blackstone's doing a couple and those are just sub-billion dollar deals.
Yes.
Point is $1.2 trillion ish, right? I think we're definitely in the neighborhood of debt that's sort of tied, coupled to the AI industry.
Can I contrast that just for a second?
Please.
We had a housing bubble. 2007, 2008, 2009, somewhere in there. Everybody in the world was buying houses. Everybody owned 10. The asset class of houses, at the time, about $40 trillion.
Wow. Wait, really? The
Yeah.
asset class of houses in 07 was $40 trillion?
So you're talking about something that is so much larger
Sure.
than even what's happening in AI. As large as as AI's debt financing is, you're talking about something that's so much larger.
That's bananas to put it on that scale. That's crazy.
Yeah.
Okay, so that's very interesting. The way that I was looking at this was that Bain & Company believes that we need about $2 trillion in annual revenue to fund the computing power needed to meet the anticipated AI demand in 2030, right? 4.5 years from now.
Sure.
They're saying we need about $2 trillion in annual revenue. Bain thinks, and I don't know if they're being conservative, my hunch is they're being somewhat conservative. They think we're going to be about $800 billion short in 5 years. So they're saying you're going to...
I think they're not wrong.
Well, I mean, I think to me, the question is like, which side are you going to be on, right? And you're probably going to be under, but they think 800. So of the 2 trillion that you need, you're going to come up with less than half, 40% of that number is what you're going to come up with. Is sort of what they're predicting by 2030.
Yeah.
That sounds like a really bad problem.
Yeah. Oh, for sure.
The incremental power needs for AI compute could reach 200 gigawatts by 2030.
Wow.
Right? With the US accounting for about half of that power. So, and this is the stat that gives me pause. If every company in the US shifted all of their on-premise IT budgets to the cloud and reinvested the savings from applying IE in sales, marketing, customer support, R&D into capital spending on new data centers. So if they took everything, which I'm pretty sure we all agree is not possible.
Sure.
But let's just say they did everything, you would still fall short of the revenue needed to fund the full investment. That seems bad. Now, that's just US. So, of course, you have ex-US that could be investing in these US services, but that still seems bad from just a orders of magnitude perspective. There was another stat in this Bain paper that I thought was super interesting, which is they suspect that AI's compute demand, so the demand for AI computation, will grow at more than twice the rate of Moore's law.
Where do they get that number, the demand being that high?
A bunch of super smart Bain Co. folks looking at a forecast. I think this is all their data, I think. So that means that you're going to increasingly have strain on global supply chain. Right, that was their outcome
For a while, and then you won't. Once you have enough compute, it won't go. Unlike Moore's law, it won't continue infinitely into the future.
Yeah, right. Yeah, the desire, right? The desire at some point will flatten out.
Yeah.
This is where I feel obligated to say at some point Moore's law has to stop. However, history has told us that is not the case. So
This is demand. This is not technological advancement. This is demand.
yes, of course. I'm saying, of course, demand has to flatten out. There has to be some asymptote that demand hits for sure. You brought up a really good point about sort of the old chips, right? And these numbers are all over the place. Some people say you can only amortize those over 2 years, that in 2 years you've got to throw them away. I do suspect that you will have usage for these older, less current chipsets, mainly to run models that folks are very comfortable with and say, hey, this is good enough. I don't need to go build ChatGPT 9 or run on that. I can run on this 5-year-old or 3-year-old model and have a bunch of business processes that work just fine on it. And I think that'll be a good use case for these older chips that they can sell at a discount. So I'm taking the over on 2 years, I think, for amortization GPUs.
It's all going to be eclipsed by RISC-V.
Sure.
If you're ARM and you're making ARM designs, if you are Intel and you're making old school Intel designs or even new Intel designs, you have to be looking at the future and going, we're in trouble with RISC coming after us. If you are Nvidia, your future looks so bright because you're just printing money.
Yes.
You do have to look back and go, wow, RISC-V is right on our tail.
Yeah, of course.
While we're chatting about Nvidia, let's move on to the next section here.
Yeah.
Isn't there a bunch of circular investing happening here?
Yeah. Now, again, when you say it that way, it sounds really, really dirty. And maybe it is. In order for me to understand this, by the way, I had to go find an infographic that Bloomberg put together that has like a dozen companies on it. And there are arrows going between every one.
For which way money is flowing. Yes.
You have customer relationships, preferred vendor relationships, investor relationships. They did not size the arrows to the size of the transaction, which disappointed me because that's the one thing that would have made it better.
Sure.
But let me just tell you, it is a mess. I'll put a link in the show notes, and it is an absolute mess. Now, this is typically something, and when I first read about this, I was like, oh, this can't be good. Some of these investments, when you've got Nvidia writing a check into OpenAI and then OpenAI buying them, I think part of that is how you get to play. Like if you want an allocation of those chips, like Nvidia can just sell them at all day long at kind of whatever price they want because the market's so hungry.
Can they?
This is the debate.
So many of those chips are being sold to OpenAI and the companies who are producing these data centers.
Yes.
Oracle, who is, by the way, in bed with OpenAI. They made a $300 billion deal with OpenAI. So now they're using that $300 billion or a portion of that $300 billion to buy more chips from Nvidia.
Well, that $300 billion put their market cap through the roof because OpenAI said we're committed to this deal. And now they have a lot more money that they can print. Oracle can print.
Yeah.
I totally totally understand the circular argument here. Normally I would be, and I wasn't when I first looked at this, pretty sketched out by it because this doesn't feel good. It doesn't feel good when your vendor is writing a check to you, then you're writing a check back for the things that the vendor just provided to you. My counterpoints to this, though, are these folks are sitting on so much cash right now, they have to deploy it somewhere.
Nvidia is.
Yes, Nvidia, especially Nvidia.
Yes.
And what better place for Nvidia to deploy it than in strategic partnerships with people that buy their stuff? Like, that actually seems like a good deal. What else should they be investing?
That's not Nvidia. I get why Nvidia wants to put their money in. I totally get that.
Yes.
OpenAI, though, is not getting better deals for money elsewhere. So the circular investment is telling us something about OpenAI's ability to raise money. It's easier for OpenAI to raise money from vendors than it is from other sources
but
of
I'm
investment.
not convinced that's true because not all money is the same. If you're saying sort of like for like, you're implying it's easier for them to get $100 billion from Nvidia than to go get $100 billion from some PE firm somewhere. But that PE firm might not be able to offer them the chips that they need.
Chips at a discount.
It might not even be a discount. It might even just be allocation.
Nvidia's investment is a self-collateralizing asset.
Nvidia's investment in what? In OpenAI?
Nvidia's investment in OpenAI is self-collateralizing because literally that money is coming
right back
to
to
them.
them. Yeah.
As a purchase of chips.
Yes.
So they're getting these shares at really an extraordinary discount.
They're getting their shares at why is it an extraordinary discount? Oh, because
they're paying for them with because their margins are 56% or whatever they are.
But maybe that's why they cut the price down, take half their margin out or something. I don't know. Who knows? But very good point. Yes, they are getting a better deal because they can effectively lever up their money using the margin they're getting back. But is that bad? If OpenAI needs it,
take a look at the AMD deal, which kind of works in the reverse way.
Yeah, this one I know less about. Tell me about this one.
It's a multi-year, multi-generation chip supply deal that includes issuing OpenAI a warrant for up to 160 million shares of AMD common stock.
Interesting.
Which is up to 10% of AMD.
Wow.
In exchange for this equity, OpenAI will deploy 6 gigawatts of AMD Instinct GPUs.
That is bananas. When they wrote up that LOI, somebody was like, "Are you sure 6 gigawatts?
Right.
Like, we mean gigawatts." That is bananas. That is the deal.
This is AMD securing that they will be a customer of OpenAI's.
I mean, okay, let me say it a different way. Tell me if you agree. Isn't in some ways this AMD just staying relevant? Like, even if AMD did this at cost, I'm not saying they did, but even if they did that at cost, isn't them just staying in the race somehow? Like, I'm not sure
it's a race they even want to be in.
That's a great question. I don't know. You got to ask their CEO. I'm not sure what you would think.
Why would that be of interest? I know it's volume.
I mean, this is really fascinating to me. And again, I know less about the AMD deal than I do the Nvidia deal, but it seems like it makes sense to both sides. Who's losing? I got to believe somebody somewhere is losing. Are the shareholders losing? I don't know. OpenAI needs chips.
Potentially, the shareholders would be the ones who are holding the bag, the overvalued bag.
The shareholders on AMD have 10% dilution sitting over their head potentially if these warrants are executed.
That's fine. And the AMD chips are terrific.
But the option might be you go to zero because you don't win, you don't exist.
They don't go to zero.
Question.
They're still going to sell chips to desktops. AMD is going to have the same problem everybody has because RISC-V is nipping at their heels.
Sure. Yeah. I mean,
the other interesting chip deal, and you can't leave this one out, is the Broadcom deal.
Oh, I don't know the specifics on this one either. What's the Broadcom deal?
They have a partnership with OpenAI to build specialized proprietary chips and systems.
Yes.
They want to co-develop
systems.
10. Listen to this. They want to co-develop 10 gigawatts of custom AI accelerators to be designed by OpenAI and built in partnership with Broadcom.
It literally sounds like an episode of Back to the Future.
It's crazy.
At what point does Broadcom need the lightning bolt to hit the clock tower to power all this crap? Like, that's got to be coming.
Well, the amount of power,
at some point.
That's another issue.
Absolute another issue, right? I mean, there's some crazy stat where some massive percentage, I want to say 85% of the Fortune 500 were pledging 10 to 40% of their budget to AI over the next. And I'm like,
most of them don't know how they're going to use it, how it's going to.
Most of them
be used.
I think you're being too
businesses.
gracious. I think all of them don't know how they're going to use it. They're trying to figure it out.
Right.
Which is why I take that number with a grain of salt, right? Because to me, this is like big trial. If we don't figure this out, we're going to be left behind. So we at least have to sort of spend what our competitors are spending and hope we get to a similar or better place. Mm-hmm. But I'm not convinced that that's going to carry on. But you have some of these businesses, like especially the AI coding companies that have gone from zero. They've humped it for years to get to $1 million of ARR.
Sure.
And then in 6 months, they go from, single digit millions of dollars of ARR to 9-figure ARR in months.
You mean like Cursor, those kind of companies?
Yeah, you've got Cursor, you've got Windsurf, you've got a bunch of these that now have multi-billion-dollar valuations, but they've got hundreds of millions of dollars of revenue that they didn't have a year ago. Like, that it breaks my brain. They were doing their ERP was QuickBooks at the start of the year, and now they're like, we literally have overflowed a field because it can't do the number this big.
Oh, sure.
Like, it's that sort of stuff.
Those little businesses that are post the AI data center companies, the
non-hyperscalers.
Those companies, yes, we're seeing a lot of those companies, and many of them are being quite profitable for their size.
And this is maybe a bit of a digression what we're talking about here, but I think it leads into some of the bubble talk of like, how many of those are just features? Like, how many of those are going to survive? I don't know.
If you've seen somebody code on Cursor, there's no way they're going back.
Oh, no. I'm sorry. Yeah, I agree with that 100%. I'm talking about all the other sort of built on top of AI. Like, I do this thing because there's this little tiny bit of friction that I found, and I'm going to solve the friction. And I'm like, if they change two things in how they aggregate data, your business is dead.
Sure.
And I extrapolate from that. What does it look like when everyone can write software without knowing how to write software? Everyone can create logical software without even being logical.
Here's the deal. I don't need a generalized AI to be able to write software.
Yes.
Eventually, that just becomes an edge computing device. That becomes
your phone. You just ask your phone.
Yeah, exactly.
There's a little CPU on your phone that does the thing.
It doesn't have to repeat to a data center to make it happen. It can literally just be a little Coral processor, size device that makes that happen. It's going to be a little RISC-V device that does that locally on your machine.
Yeah.
And those little tiny little TPUs that are running on your RISC-V chip use just this micro amount of power.
Yes.
They just use this tiny amount of power.
For perspective here, folks, single digit trillions of operations per second. And you're talking about like 1 or 2 watts.
On a Coral chip.
On a Coral chip.
Yeah.
And guess what? In 18 months, I can tell you for sure, it's going to be about half as much power.
Oh, for sure.
That's what's going to happen. It's almost no power to do these things.
So the final question, how does this bubble end? If this is a bubble, or if it's not a bubble, what happens?
Great question. There's no way around making up this revenue gap, right? You've got this large gap of revenue against expenditure that has to be made up.
Anytime you are investing, anytime you're an investor, you have competing income streams. That's all you're buying is an income stream.
Yeah.
And then you have to evaluate how sure of an income stream is this? That's evaluating the credit risk. And then will there be growth to it? Am I going to calculate in how much growth I think is going to happen into this?
Yeah.
A lot of times that growth doesn't actually materialize.
But as you mentioned earlier, right? If you end up having some contraction, and I'm going to define contraction as like a deflation or a burst, I would say with reasonable certainty, the tech's not going to go away. And a bunch of the stuff's going to get picked up and glued back together, and something's going to exist going forward. Like, I'm pretty confident of that. And someone with presumably a bunch of capital and some patience is going to be able to pick up these things at the right time.
You and I don't particularly care if Nvidia loses a lot of money on their investment in OpenAI. We really don't care if Oracle loses its, investment in OpenAI. Those things don't really matter to us.
Yeah.
However, we do care about how much of the U.S. economy is being held up by all this AI spending.
I mean,
look at those numbers.
A bunch of the badness of the economy right now is being swept under the rug because it's all propped up by these AI investments. Like
AI spending accounts for all of the growth that is happening in the GDP right now.
Oh, yeah.
Anything else you want to add to this? Any last thoughts you have on the AI potential bubble?
Maybe loosely related to the bubble, I would strongly suggest that folks just go dive in head first because it is very interesting. And the more I talk to people, the more even
dive in head first to using AI.
To using AI. Sorry. Yeah.
Yes, of course.
Sorry. Not to investing in AI. That ship might have sailed. You might not want to write your check into OpenAI at this current valuation if you can get in. Using it's really quite fascinating. And I really do not see a world where this goes away. So you're just going to see more and more of it.
Oh, no.
And don't be the person who, in 2004 was still looking up businesses in the phone book to find their phone number. If you're still searching on Google, like I am, you're at risk of becoming that person.
Although when you search on Google, you now get an AI answer at the top.
Yes. It's just like at the very top of the Yellow Pages, it said go to yellowpages.com. It doesn't mean I did it. I still scroll down and find the blue link 25 links down.
My last thought is that there is a second AI bubble that I think a lot of the world is not accounting for.
Yeah.
That is going to be terribly important, but I think it's going to remain invisible. And that is AI companies take their content freely from the open web. They don't pay the websites for the information that they're getting.
Well, they've got a couple deals in place, but generally speaking,
it's small. It's really tiny. The websites paid writers or content creators for that content. If the website no longer makes money, they can no longer pay those content creators, those writers.
You then no longer get that content.
And there's no longer that content for those AI companies to slurp up.
Yeah.
So that I think is an invisible but equally problematic bubble.
I think this is going to be a sticky wicket that we're not going to spend a lot of effort trying to figure out for too long. Like we're going to chase the software, the implementation side, and not focus on the content side. And the wheels come off the bus
if you don't have the content.
If you lose the content side. Yeah, they're like, I just had this debate earlier this week. I'm like, if the content owners don't have a mechanism to do the thing that they're doing, then what happens?
Then AI doesn't have anything to answer you back with.
I usually get some hand wave, and you're like, well, the AI will figure it out. I'm like, what are you talking about?
It can't.
You're going to just have instead of journalism, it's just going to scrape a bunch of security cameras and try to put together an article? Like what? No, like you still need journalists. You still need people creating good, high quality content. Like that has to be.
It's tough to think about things like Reddit throwing up their hands in the air when AI is the thing that everybody goes to look for answers on. So Reddit says, all right, shut down the lights, turn it off. It doesn't make any financial sense for us. And then most of AI just collapses on itself.
Sure.
Because so much of it came out of Reddit.
Yeah. There's a lot of knowledge hives we haven't even gotten close to tapping yet, and they're still there. I'm not too worried about that problem. I'm more worried about how do you continue it going forward. And Reddit might not be the answer, but there is some sort of community knowledge hive answer. I think it will evolve, and it will probably be some new thing or some new set of things that will enable that in an AI world.
All right, we have to get out of here, but quickly before we do, have you seen or read anything good this last week?
Well, yeah, I mean, completely on point to this episode. There's a show that I watch occasionally that's called the AI Daily Brief, and it's specifically about AI. As prep for this show, I watched one of his episodes from earlier this month that was about the 5 reasons AI is in a bubble and 5 reasons that it's not.
Yeah.
And he goes into detail on a couple things that we don't touch here. Certainly, I don't necessarily disagree with him, but it's an interesting sort of thought experiment. It's only 20, 30 minutes long. I'll put a link in the show notes, but it's a really fun idea adventure, especially comparing what we have now in this potential AI bubble compared to what we had 25 years ago in the .com bubble. And I think if you liked this episode, you'll enjoy it.
Really well presented.
Yeah, super well presented. I love the content he presents. It's really awesome and does it far too often. I don't know how he's producing this much content because we can barely get this show out twice a week. So much talking. How about you? What have you seen?
Well, of course, I'm going to have to mention 2015's movie, The Big Short.
Oh, of course.
In 2008, the global economy imploded. This is the story of the outsiders who saw it coming. Based on the nonfiction bestseller by Michael Lewis, The Big Short is a high-octane, darkly comedic look at the few financial mavericks who realized the U.S. housing market was in an enormous fraudulent bubble and bet against it. A doctor with a glass eye, a rage-filled Wall Street banker, 2 young investors operating out of a garage short the entire system. Director Adam McKay brilliantly breaks the fourth wall, enlisting celebrity cameos including Margot Robbie in a bathtub to explain confusing concepts like synthetic CDOs and subprime mortgages. It's an infuriating and hilarious expose on the institutional stupidity and unchecked greed that nearly brought the world to its knees. The banks got greedy, these guys got rich. The Big Short, available for rent on Amazon Prime, YouTube Movies, and the rest of the usual suspects now.
Now, I've never actually seen this film, but I read the book.
Oh, it's so good.
And it's fantastic.
Yeah, the book's amazing, but the book and the movie are nothing alike.
I've got to watch the movie. I know, you've told me this before. This story, by the way, reads like fiction. You're just like, there's no way that any of this happened.
Sure.
All of it's 100% real, right? It's a fascinating story, and it's really well told.
Michael Burry is still out there picking out bubbles. He's the doctor who has the glass eye.
He attributes the ability to do that primarily to like his Asperger's of just being like, well, I see things other people don't because I see things in a different way.
He's not susceptible to the herd mentality.
Yes, exactly.
That is the episode.
Thank you for joining us for all this nonsense. A truly terrible podcast from our awful company. Visit us on the web at nonsense.productions. I'm Stu Little.
I'm Jeff Parker.
If you like this program, please follow, download, subscribe, and like at Apple Podcasts, YouTube Music, Amazon Music, AntennaPod, iHeartRadio, Spotify, my favorite Overcast, wherever you may get your podcasts from.
Nonsense uses SyncThing. Make sure you always have the latest version of all your files on all your computers anywhere you are in the world. SyncThing does that effortlessly. Free and open source. Be sure to check out SyncThing.
SyncThing is fantastic. It's like Google Drive, but a lot better.
Way better. Oh my gosh, so much better.
We'll be here every Tuesday and Thursday morning for more nonsense. Please join us. We don't know what the upper bound looks like. We don't know how much compute we need.
Right.
All I know is every time I run a stupid video of Richard Pryor making a cake for Tom Petty and Sora 2, someone has to turn off their kitchen light in Boise.
It does use a lot of power.
Sorry, buddy. Enjoy the dark.